If you're looking for a shortcut to understanding the complex world of global finance, well, you are in the right place. Today, we are undertaking a deep dive into Japanese markets where one single political announcement created this stunning, really self-contradictory financial event.
It was a perfect snapshot of Japan's current economic tensions. And our mission today is to unpack this core paradox. How could news of a potential snap election cause Japanese stocks to soar to an all-time high, while at the same time triggering an outright panic, a full-scale retreat in the country's bonds and its currency?
Exactly. We have a stack of sources here detailing what analysts are calling the reemergence of the Takaichi Trade. And the central trigger here was pure politics. Prime Minister Takaichi Sanae signaled she intended to dissolve the Diet around January 23rd for an early general election.
And that political move, it immediately rattled markets globally. I mean, elections usually just mean uncertainty. But in this case, the response was so specific. Investors saw a chance for Takaichi to get a stronger mandate, and they reacted by, well, splitting their bets right down the middle.
Creating that intense split you mentioned. Okay, let's unpack this strange event, starting with the euphoria. The immediate positive reaction was overwhelming. The Nikkei 225 index didn't just tick up, it surged over 3%, hitting a historical high. It was fueled by this really aggressive risk-on sentiment.
Absolutely. Pure gasoline for equity investors. That stock rally tells you exactly what they believe a stronger Takaichi mandate means: guaranteed stimulus and continued cheap money.
Right.
But if you were watching the fixed income market, the story was fundamentally different. The volatility was extreme, and the sell-off in JGBs, the Japanese government bonds, was fierce.
We really need to spend a moment on the gravity of this bond panic because it's maybe the most alarming part of this whole story. You have to understand, Japan has spent decades fighting deflation, keeping rates pinned near zero. So what did the market do when this election news hit?
It priced in massive systemic risk. And you have to look at the specific numbers because they are historically shocking. The benchmark 10-year government bond yield climbed sharply to 2.135%.
Okay, 2.135%. That might sound low to people listening elsewhere, but for Japan.
For Japan, that is a new 26-year high. We haven't seen rates that high since February of 1999.
Think about that context for a second. 1999 was a completely different era for Japan, a very, very early stage in their long battle with deflation. To jump back to that level is, like you said, just shocking.
And it got worse further out on the curve. The 20-year bond yield rose to 3.135%. That is an all-time historical high. And when we say all-time, we mean it. The market is basically saying the long-term risk of holding Japanese debt has never been greater. The 30-year yield also surged 12 basis points to 3.52%. Now, that's 0.12%. But in the usually glacial JGB market, that kind of move is a panic signal.
So unprecedented bond selling. And this flight from debt was matched by a flight from the currency, right? The yen was in similar trouble.
It certainly was. The JPY-USD rate fell dramatically to 158.91. That's the lowest level for the yen since July of 2024. And this combined abandonment of both the sovereign debt and the currency, while simultaneously piling into stocks, that's the defining characteristic of this Takaichi trade.
So this is the core tension we need to resolve. Why does a potential political victory instantly translate into this financial contradiction? What's the core premise of the trade that makes investors so optimistic about equities but so terrified of bonds?
The mechanism is pretty clear. Investors are betting that a stronger mandate from an early election will completely consolidate PM Takaichi's political power. It means she can basically ignore the voices of fiscal conservatism and just push forward with her aggressive policy agenda.
Her preference for massive.
For massive expansionary fiscal policy, yes. And that's coupled with a continued, let's say, reluctant preference for loose monetary policy from the Bank of Japan.
That immediately explains the stock enthusiasm. Stimulus and cheap money, that combination is absolute catnip for equities. But let's define the specifics. What exactly are investors wagering she'll do if she wins that stronger mandate?
They're wagering she will swiftly proceed with her large-scale stimulus plan. It's been widely reported to be valued at around, $135 billion? This isn't marginal spending. This is a huge injection of capital aimed right at boosting domestic growth and corporate profits.
And the stock rally is just a celebration of that anticipated liquidity.
Exactly, and government support.
But liquidity always comes with a cost. And that celebration is immediately tempered by a deep structural fear, which is why the bond market crashed. Let's focus on this connection. Expansionary fiscal policy is great for corporate balance sheets, but potentially disastrous for debt sustainability.
That's the structural flaw that the bond market is screaming about. Japan is already the developed country with the heaviest debt burden globally. Its debt-to-GDP ratio is already over 200%. So the bond sell-off is a clear reflection of just acute investor anxiety over future fiscal discipline.
Right. When the government, which is already burdened with debt twice the size of its entire economy, proposes injecting another $135 billion, the market has to ask two essential questions. Who pays for this, and how does this mountain of debt ever get serviced?
Exactly. It's basically a vote of no confidence in Japan's future fiscal capacity. The bond market isn't just reacting to the immediate debt load, it's reacting to the signaling. The idea that fiscal discipline is taking a backseat to political maneuvering and, aggressive spending targets.
Okay, but let's introduce a challenging counterpoint here from our sources. Nicholas Smith, a strategist at CLSA Japan, he noted something interesting. He said that while inflation is currently running higher than interest rates, the net debt is technically declining. So is the bond market maybe overreacting?
Well, that's a valid technical observation, that inflation is currently eroding the real value of the debt faster than interest rates are adding to it. That's true in a vacuum. But the market isn't a vacuum, right? It's reacting to perceived political risks. When a leader signals they're willing to spend $135 billion despite that 200% debt to GDP figure, it erodes trust in long-term fiscal prudence. The bond market is saying, we don't trust you to stop spending once this election is over.
That makes perfect sense. The structural problem, just the sheer size of the debt, makes any sign of aggressive spending a huge red flag. The $135 billion plan is essentially just pouring gasoline on that vulnerability.
And that acceleration, combined with the incredibly slow pace of monetary tightening by the Bank of Japan, it creates the perfect currency cocktail for weakness. And as MEOPG analyst Lee Hardman, he synthesized the twin problems really well. Fiscal concerns are high, and the BOJ isn't doing enough to offset them by raising interest rates.
Which makes the yen highly susceptible to further weakness.
Extremely susceptible.
And the yen has truly been suffering. I mean, under the dual pressure of this political turbulence, this Takaichi Trade, and the continued U.S.-Japan interest rate gap, the yen has unfortunately become the worst performing currency among the G10 group. It's just a continuous, punishing slide.
That massive rate differential is the engine driving the capital outflows. Investors just can't justify holding yen-denominated assets, not when they can get significantly higher returns on dollar assets, especially with Takaichi's policies signaling more liquidity and inflation risk ahead.
And this persistent slide is fueling some genuinely grim forecasts. Market observations suggest that if these capital outflows continue, combined with those deeply negative real interest rates, the JPY-USD rate could be pushed down to 160, maybe even lower, by the end of 2026.
And a drop to 160 isn't just an abstract number. It represents a serious erosion of purchasing power for Japanese consumers, a massive complication for import costs. So the severe depreciation has naturally triggered official alarm. And that brings us to the intervention watch.
Right, we saw Finance Minister Katayama Satsuki jump into action, traveling to Washington to meet with the U.S. Treasury Secretary Bessent. What was the key message there? What was the objective of that meeting?
Katayama went to Washington to lay the diplomatic groundwork. She, quote, expressed concern about the unilateral weakening of the yen, which Secretary Bessent reportedly shared. This official dialogue is critical because coordinated intervention, where the U.S. doesn't object, is always less risky than Japan acting alone. The warning shot was very public.
And Katayama Satsuki has made it explicitly clear she's willing to follow through. That's what's giving the market real reason to be nervous, isn't it?
Well, absolutely. She has repeatedly stated she has the discretionary power to intervene if needed, and the precedent is haunting the market. The last time the Ministry of Finance intervened was July 12, 2024. At that time, the JPY-USD rate had just touched 159.45.
That's fascinating. Because the market is hovering dangerously close to that exact historical intervention level right now, it just hit 158.91. But this is where Shokyo Mori from Mizuho provides a crucial bit of nuance. Officials aren't necessarily targeting that specific level, are they?
That's the key insight. And it's what keeps traders on edge. The Ministry of Finance isn't necessarily focused on stopping the yen at 159 or 160. Their focus, according to Omori, is on whether the fluctuation is, quote, excessively unilateral and rapid.
Okay, so let's step away from the specific number for a second. If they're not targeting 159.45, how do they measure unilateral or rapid? Is it about the pace of the drop or the direction?
It's both. Unilateral means the yen is weakening severely against the dollar without the dollar itself gaining strength globally. Rapid means the market move is just too fast for businesses to adapt, and it destabilizes confidence. So if the yen continues to crash over a few days like that, the intervention risk is very high, regardless of the level.
So they're targeting the speed and the direction of the move, not the final destination.
Exactly.
That explains why the market is so jittery. Despite the fundamental reasons for the yen to strengthen, mainly the anticipated U.S. rate cuts coming down the pike. Nicholas Smith acknowledged its performance has been extremely stubborn. It just refuses to rally.
Stubborn is the perfect word. If the market were purely rational, anticipating a slowing U.S. economy and Fed easing, the yen should be strengthening. The fact that it keeps crumbling suggests that the domestic structural concerns, the debt, the political signaling, are just far outweighing the traditional global factors. And that puts policymakers right in the spotlight.
So what does this all mean for you, the listener, following this deep dive? This news of a snap election perfectly encapsulated the deep contradiction at the heart of Japan's economy right now. You have strong risk appetite fueled by promised stimulus. That's the stock market surge, the Takaichi Trade euphoria. And then you have this deep-seated anxiety over debt sustainability and currency value. That's the crash in bonds and the yen. It's a financial system completely divided against itself.
And if we zoom out to the broader economic picture that underpins all this, it becomes even more precarious. We have to remind you that Japan's core consumer price index remained elevated at 3.0% in November. And critically, that marks the 44th consecutive month that inflation has stayed above the central bank's target.
44 months.
This sustained high inflation fundamentally underpins the case for the Bank of Japan to eventually tighten policy, regardless of what the prime minister's political desires are.
So the stage is set for a massive collision. We have PM Takaichi's preference for aggressive fiscal spending, that $135 billion stimulus, and we have sustained elevated inflation. So the critical question remains, how long can the Bank of Japan truly maintain a loose monetary stance, keeping rates low without severely jeopardizing the yen and escalating these debt concerns into a genuine crisis? We are potentially watching a forced collision between Japan's fiscal and monetary policy, and the outcome of that tension is what you should continue to watch closely.